Welcome to Factful Finance, where we transform complex financial concepts into clear, actionable insights. Ever wonder how the economy's interest rate decisions impact your daily life or your business? You might be surprised at how these shifts can affect everything from your mortgage payments to the price of your morning coffee. Interest rate hikes and cuts are more than just numbers on a central bank's chart. They have real, tangible effects on both businesses and consumers. In this video, we're diving deep into exactly how these changes ripple through the economy, from the boardroom to your personal finances. So, how do interest rate hikes and cuts affect the economy? Let's explore this critical issue from a financial economics perspective. First, let's break it down. When the Federal Reserve raises interest rates, borrowing becomes more expensive. Imagine you're a business owner like Olivia, who runs a local coffee shop. She's been considering expanding to a new location, but with interest rates climbing, she might hesitate. Why? Because taking out a loan to finance the expansion will cost her more in interest payments. That means the cost of doing business just increased, potentially leading her to delay or reconsider the move. On the flip side, when the Federal Reserve cuts interest rates, borrowing costs decrease. That means businesses like Olivia's have more incentive to borrow money for expansion, research, or even to hire additional staff. So a cut in interest rates could be a signal for businesses to invest in growth, hire more employees, or offer new services, all of which can stimulate economic activity. Now let's shift gears to the impact on consumers. Consider Liam, who's looking to buy his first home. If interest rates are high, the mortgage rates that lenders offer will also be high. For Liam, this means higher monthly payments for the same property, making homeownership less affordable. High interest rates can make people like Liam more cautious about big purchases. They may hold off on buying a car or take fewer vacations, opting to save rather than spend. But if rates are cut, as we saw in the early 2020s, mortgage rates drop, making homeownership more accessible to first-time buyers like Liam. For consumers in debt, lower rates mean lower monthly payments, freeing up cash for other needs, like saving for retirement or tackling high-interest credit card balances. So what's the bigger picture? Interest rate decisions by central banks are a tool used to control inflation and stabilize the economy. When inflation is high, central banks may raise rates to cool things down. This leads to higher borrowing costs, reduced consumer spending, and less business investment. Conversely, when inflation is low, central banks may lower interest rates to encourage borrowing, spending, and investment, helping to boost economic growth. But it's not all about rates alone. The timing of these hikes and cuts also plays a crucial role. Let's take Amelia, a small business owner in the tech industry. If rates rise just as she's ready to launch a new product, she might find it more challenging to secure financing at a reasonable cost. In contrast, if rates are cut before her big launch, she could secure more favorable terms, making it easier to fund her expansion. The connection between interest rates and inflation is also crucial here. Interest rates directly influence consumer spending, business investment, and the cost of borrowing. When borrowing becomes more expensive, both businesses and consumers tend to pull back, leading to lower demand for goods and services, ultimately cooling down inflation. When rates are low, demand surges, potentially pushing inflation up. It's all about striking the right balance to keep the economy humming along smoothly. So how can you prepare for interest rate changes, whether you're a business owner like Noah or a consumer like Ava? First, stay informed. Know when central banks like the Fed are likely to adjust rates and anticipate how these changes might affect you. If you have a mortgage, a credit card, or any loans with variable rates, paying attention to rate hikes or cuts can help you make smarter decisions about refinancing or managing debt. If you're a business, plan ahead. Lock in favorable rates when they're low, and consider adjusting your pricing strategy if rates rise. And consumers, don't let the uncertainty of changing rates throw you off. Build a financial cushion, manage your debt wisely, and be strategic with big-ticket purchases. At the end of the day, understanding how interest rate changes impact both businesses and consumers is crucial for navigating today's financial landscape. Whether you're looking to grow a business, buy a house, or simply manage your money better, Staying informed about interest rate trends will give you a significant advantage. Want to take your finances to the next level? Hit the like button, subscribe, and share this video with someone who could benefit from understanding the power of interest rates. And remember, this content is for educational purposes only. Always consult with a certified financial professional for personalized guidance. If you found this helpful, you'll love what's coming next. Click the video on screen.